In this video, we're going to talk about Senseonics, trading under the ticker symbol SENS. At the moment, there are massive movements coming out of the stock, and it's going to be important to stay up to date with the latest price movements. In this video, I will be covering technical aspects and how the stock performed over the recent period to identify an overall approach with the stock. Before the video begins, just a quick heads up that my videos are based on the trading sessions already completed, and not all my videos are recorded on the same day they're posted. If there are material changes happening afterwards, I will make follow-up videos to reflect those changes. With that being said, let's begin on today's topic. Senseonics is a medical startup developing devices monitoring glucose level for people. They already have a line of products allowing patients to monitor their status in a timely manner. Their devices connect to phone applications as well, so they're quite flexible and convenient for the patients. One of the key reasons why we're here talking about this company at all, and why it had some significant amount of success in the past, was because the company was chosen by ARK Invest as one of the potential disruptors of the future and invested massively into it. Of course, things have changed somewhat since then, and nowadays SENS, or Senseonics, is facing challenges in this new phase of the market. During the Thursday trading session, Senseonics shares first increased from $3.55 to around $3.85 by the middle of the day, but then began having selling pressures from the market and began a relative sell-off that finished at around $3.60. It is a slight decrease if we look at the stock over 24 hours, but it's definitely a sign that the market is reducing the steam upward that it currently has. On Friday, we saw that price to fall significantly more from there, to around $2.45 by the end of the after hours. A likely explanation of the stock price slip may be caused by the 2022 outlook, and the fact that many shareholders may be tempted to sell as soon as the price gets slightly above their cost basis. I had a similar tendency to do so when it came to Lucid shares way back in late 2021. With that being said though, I believe that the overall stock price of Senseonics will be adjusted in the near future, and the market will soon correct itself from the recent movements. When we take a step back and look at the entire price evolution, it's not hard to see that Senseonics has been struggling over the recent past. Before taking off once again, at the moment, Senseonics is at a relatively high position though. So definitely keep that in mind as we go forward, because there have been multiple attempts to go above the $4 level and to stay there. So far, those efforts were not succeeding. And the other thing is that so far in 2022, it seems like most people in the market are relatively reluctant to take risks in the growth stocks area. This is why I believe that those elements should encourage us to remain prudent. With that being said, let's take a look at the technicals. The volume of Senseonics has recently been 14 million shares, compared to an average volume of 12 million shares. Over the previous 52-week period, its price fluctuated between $1.52 and $5.56. The market cap of Senseonics is currently at $1.6 billion versus an enterprise value of $1.9 billion. The difference between the market cap and the enterprise value is the premium or discount financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. One typical example of this impact is the high leverage some companies may have. The market would feel uncertain about the company's future and its capacity to pay back the interest and principals, which then negatively impacts the profitability, attractiveness, and even solvency of that company. Something to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill, which is basically an expectation of the market that the company can generate more profit or to have more growth than its rivals, because it is assumed to have a better management team, stronger brand recognition, or bigger online following. It is basically what is unique about this company in particular compared to other ones in the sector. It's not a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value. So if the company goes to liquidation, the goodwill is completely gone, and we would be left with potentially less assets for the shareholders and debt holders compared to the figures shown on the balance sheet. Regarding the historical price fluctuations, the stock is currently 74% higher than the 1-month low, 75% higher than the 3-month low, and 125% higher than the 52-week low. On the options market, which often gives a hint on a market sentiment on where the stock price is likely going to go, the implied volatility is 143% compared to a historical volatility of 82%. The put-call volume ratio is currently at 0.22. It is normal for most stocks to also tend to have a higher put option volume than what they truly deserve, because many institutional investors choose to hedge their exposure by buying put options. The most recent volume of options traded has been 17,000 contracts in a day, compared to the 30-day average volume of 16,000. Regarding the open interest, the most recent volume of open interest was 375,000 contracts versus the average of 367,000 contracts. Regarding its shareholder structure, institutional shareholders own about 30% of the outstanding float. The biggest shareholders include BlackRock, Vanguard, and iShares. Understanding shareholder structure is relevant because it helps to determine if you should be holding the stock long-term or to simply trade the stock short-term. If the stock is mainly held by retail traders, it may be a sign that the stock lacks the depth to justify long-term holding. Of course, not always. Usually, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as an investment rather than a trade. But of course, a lot of exceptions may apply since many companies are held mostly by retail and not institutional investors. But so far, this is the exception and not the rule. Let's also take a look at the short interest present in the stock, which is basically the amount of positions aiming to profit should the share price fall lower. The current short volume is 25% of the total float, and 28% of it coming from the dark pools. Let's also take a look at indicators. The oscillators are showing 2 sell, 6 neutral, and 3 buys, with an overall tendency of neutral. The moving averages of the past price actions show 1 sell, 1 neutral, and 13 buys, with an overall tendency of strong buy. Keep in mind that the indicators show the present and the past performances, rarely predicting accurately the future. Nevertheless, they are relevant to determine if the timing of the trade seems to be the right one or not. Regarding the pivot points, which are levels of support and resistance, they are $1.63, $2.50, and $2.59 for the support levels. For the resistance levels, they are $2.77, $2.86, and $3.61. My opinion about Senseonics is that it's definitely a decent company that is worth having a look into, but the question is about the timing and the exposure. With the recent price actions, I think that it would be wise to buy the shares in batches after seeing some support. I think that the market is currently very sensitive to any sort of negative outlook about the medium-term economic forecasts, and any of those can result in significant sell-off. With all that being said, it's an interesting week for sure ahead of us, because we have to see whether there will be some significant support that is going to take form. I would recommend a maximum exposure of 1 to 3% in Senseonics and to have at least 25% of your allocation if it manages to hold for at least another 3 days. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.